There is a rule wealthy families follow that almost no one talks about. Not in business school, not in investing podcasts, not even in most financial advice books. And the rule is simple. They do not chase risk. They control it. That may sound obvious, but it is not how most people behave with money. Most people are taught to pursue returns. Higher yield, higher growth, higher upside. We celebrate bold investors. We glorify huge bets. We admire aggressive moves. But wealthy families play a completely different game. They are not obsessed with how much they can gain. They are obsessed with how much they can lose. Because one catastrophic loss can erase 30 years of disciplined progress. And once you understand that, the entire philosophy of money changes. You stop asking, how big is the upside? You start asking, what is the worst possible outcome? And that question is the beginning of real wealth. Let's start with a simple truth. Wealth is fragile. It takes years to build capital, but it can disappear in months. A bad investment, a lawsuit, a market collapse, a poorly structured deal. One mistake can wipe out decades of work. This is why wealthy families teach their children something very early. Avoid destructive risk, not all risk. Destructive risk. There is a difference. Productive risk grows wealth. Destructive risk destroys it. And if you cannot tell the difference, you are gambling, not investing. Here is where most people go wrong. They think diversification means owning many things. Stocks, real estate, crypto, a small business, maybe a side investment in a startup. That feels diversified, but wealthy families ask a deeper question. Are those assets actually independent, or are they all exposed to the same economic forces? In 2008, people thought they were diversified. They owned homes. They owned stocks. They owned retirement funds. But when the housing market collapsed, everything moved together. Stocks dropped, credit tightened, property values crashed. Diversification did not save them because the risks were correlated. Wealthy families understand correlation. They spread assets across systems that failed differently. Different industries, different regions, different economic drivers, different liquidity profiles. Some assets grow fast, some assets grow slowly, some assets simply hold value. And together they create stability. Think of it like engineering. You do not build a bridge with one support beam, you build many. If one weakens, the structure still stands. Wealth works the same way, but diversification alone is not enough. The second rule is risk discipline, and this is where emotional control becomes critical. You see a big opportunity, everyone around you is excited, the market is rising, the news is optimistic, your friends are making money. The temptation is powerful. You want in. But wealthy families ask a different question. What happens if we are wrong? Most people never ask that. They imagine success. They rarely imagine failure. But disciplined investors do the opposite. They stress test every decision. What happens if revenue falls 30%? What happens if the market crashes? What happens if the deal takes longer than expected? If the worst-case outcome would cause serious damage, they reduce exposure. Sometimes they walk away completely. This restraint is difficult because restraint does not feel exciting. It feels like missed opportunity, but restraint prevents disaster, and preventing disaster is more valuable than chasing every gain. Let's talk about a concept almost nobody discusses, the difference between volatility and risk. Most people think they are the same. They are not. Volatility is temporary movement. Risk is permanent loss. If a stock drops 20% but eventually recovers, that is volatility. If an investment collapses permanently, that is risk. Wealthy families focus on avoiding permanent loss. They can tolerate volatility. They cannot tolerate destruction. This mindset changes how you invest. You stop chasing explosive growth. You start building resilient systems. For example, wealthy families rarely depend on one single income source. Many people do. A job, or a business. If that single income disappears, the entire financial structure collapses. Wealthy families build multiple streams: rental income, dividends, business profits, private investments, cash reserves. Some grow slowly, some grow quickly, but together they reduce vulnerability. This is called redundancy. In engineering, redundancy saves lives. In finance, it saves wealth. Now here is another hidden rule. Position size matters. Even a great investment can destroy you if you bet too much on it. Let's say you invest 10% of your capital in a risky opportunity. If it fails, you recover. But if you invest 80% and it fails, the damage is devastating. Wealthy families limit position size. They rarely allow one asset to dominate the entire portfolio because concentration increases fragility. Fragility invites collapse. Think about famous financial disasters. Most of them came from concentration. Investors who put everything into one idea, one company, one sector, one strategy. When that idea failed, everything failed with it. Wealthy families avoid that trap, not because they lack confidence, because they respect uncertainty. Uncertainty is permanent. No investor, no matter how brilliant, can predict the future consistently. So the intelligent response is not prediction. It is preparation. Preparation means building systems that survive mistakes. Because mistakes are inevitable. Here is another rule wealthy families follow. Liquidity is protection. Liquidity means access to cash or easily sellable assets. Many people lock all their wealth into illiquid assets. Real estate, private deals, long-term commitments. That can work in good times. But when a crisis arrives, liquidity becomes priceless. If you have cash, you have options. You can survive downturns. You can buy assets when others are forced to sell. You can wait. And waiting is one of the most powerful financial strategies in existence. Markets move in cycles. Booms are followed by corrections. Corrections are followed by recoveries. Those who survive downturns benefit from the next expansion. Those who are wiped out never get that chance. This is why wealthy families protect liquidity. Not to earn interest, to preserve optionality. Optionality means the freedom to act when opportunity appears. Without liquidity, opportunity is useless. Another rule wealthy families follow is strategic caution. Caution does not mean fear. It means thoughtful decision-making. Before committing capital, they investigate deeply. Who is involved? What incentives drive the deal? What risks are hidden? What assumptions must be true for success? Most people skip this stage. They rely on excitement, or persuasion, or momentum. But wealthy families verify everything, because every investment pitch looks good on the surface. And only careful analysis reveals the weak points. Let me ask you something. Why does your CPA rarely warn you about destructive risk? Because their job is compliance. They record transactions. They do not design investment strategy. Risk management is a separate discipline, and wealthy families treat it that way. They consult specialists, legal advisors, tax strategists, investment analysts. Each expert sees risk from a different angle. Together, they create a defense system. Most individuals try to handle everything alone, which means blind spots remain, and blind spots are dangerous. Now let's talk about a concept wealthy families understand very well. Time horizon. Short-term thinking increases risk. Long-term thinking reduces it. When you expect quick profits, you take bigger gambles. You trade aggressively. You chase trends. You respond emotionally to market swings. But when your horizon is decades, your behavior changes. You invest patiently. You focus on quality assets. You allow compounding to work. Compounding is one of the most powerful forces in finance, but it only works if capital survives. If you lose half your capital, compounding slows dramatically. If you lose everything, compounding stops completely. So protecting capital is not conservative. It is essential. Now let's talk about psychological discipline. Most destructive risk comes from emotion, greed, fear, overconfidence. When markets rise, greed encourages reckless investment. When markets fall, fear encourages panic selling. Both destroy wealth. Wealthy families train emotional discipline. They follow systems. They follow rules. They avoid impulsive decisions. Because emotion is the enemy of rational investing. Think about it this way. If your investment decisions change based on headlines, you are not investing. You are reacting. And reaction rarely produces consistent success. Wealthy families step back. And they analyze calmly, they adjust slowly, and they maintain perspective. Perspective allows them to see cycles clearly. Booms, bubbles, crashes, recoveries. History repeats itself. Not exactly, but often in rhythm. Those who understand this rhythm avoid destructive risk. They recognize when excitement becomes irrational. They recognize when caution becomes excessive. They move carefully in both directions. Another rule wealthy families follow is intergenerational thinking. They do not invest only for themselves. They invest for the next generation and the generation after that. When your goal is generational stability, reckless risk becomes unacceptable. One bad decision can damage decades of planning. So they focus on sustainability, assets that endure, businesses that produce steady income, investments that survive cycles. They are less concerned with spectacular gains. They are more concerned with durable systems. Because durability produces legacy, let's revisit the core idea. The hidden money rule wealthy families follow is simple. Never allow a single decision to destroy your financial foundation. Not one investment, not one market, not one opportunity. Every decision must pass the survival test. If it fails badly, does the system still stand? If the answer is yes, the risk may be acceptable. If the answer is no, the risk is destructive, and destructive risk is avoided. And this philosophy may feel slow, it may feel cautious, but over time it creates extraordinary stability. And stability creates compounding. Compounding creates wealth, quietly, consistently, relentlessly. Because the truth about money is not glamorous, it is structural. Wealth is not built by spectacular victories. It is built by avoiding catastrophic mistakes. And the families who understand this rule do something remarkable. They do not merely get rich, they stay rich. For generations, not through luck, but through discipline. The discipline to control risk before it controls them.